We've already seen 2 quarters of negative GDP in the US. We've already seen housing rollover. We've already seen supply chain issues ease. We've already seen most commodity prices fall 50%. We've already seen the dollar explode higher. The dollar's hugely deflationary because the largest exporting nations in the world, Japan, Germany, China, have all seen their currencies decline massively. So they're now selling finished goods at much lower prices. So the macro turn is very close. When we look at on-chain analytics, we start to see things that only ever happen in these massive bear market sell-offs. The 2014 sell-off, the 2017 sell-off, stuff like that. We also are at the bottom of the logarithmic trend channel, 2 standard deviations oversold. That's usually a good one. We're at the 5-year exponential moving average. That level has proven to be about the best risk reward you can ever find. Things like, if we use technical analysis, things like the RSI are oversold as they have been at the bottom of every other cycle. At the time where the macro narrative is at peak, everyone's like, inflation's going to be 20% forever and Europeans are going to be dying in the streets because there's no food and they can't afford to heat their houses, right? That's the narrative right now. Okay, so how much worse can this be? And any rate of change means that the risk reward, normally when you get to this confluence of events, the risk reward is somewhere between 20 to 50x. Now, it depends where you are on the risk curve. My working hypothesis was, I'm not sure the equity markets are going to make significant new lows, and I'm still not. They may break the low, go a bit lower, and then break back higher again, because the sentiment in equities is unparalleled. I'm about to write this in Global Macro Investor. It is the worst sentiment in any measure of any survey in the history of equity markets. So people are record bearish. They're terrified because of what's going on. The bond market, which is the anchor pricing for everything, is unhinged. And the dollar, which is the big daddy of all macro assets, has become untethered as well. So it is a scary situation. Listen, there's 2 games at play here. One is those guys who want to be Volcker, and they're having their day in the sun. But in the background is a much more powerful group, and that is the politicians. The politicians are the ones that actually set policy. When the politicians decide that economic growth has gone too far, they will change the game. And I believe that. And that's where quantitative easing, direct handouts, and other stuff to alleviate the pain that's going on. They can't have mortgage rates like this for very long before unemployment starts coming and this becomes a big problem for the Biden administration or whichever administration in whichever country you've got to deal with. So therefore, the propensity for there to be, if this trend continues that we're seeing, there is a propensity for the market soon to start pricing in, somebody's going to have to step in here, much like they did in 2020. So that is still remains my view, is the politicians will end up pushing the Fed around. I think the Fed have created this by fighting the wrong battle, because the battle they remember was the battle that their heroic hero Paul Volcker fought. It ain't that battle. They're fighting the wrong thing. We've got a big problem on our hands, but over the next few weeks, as this pushes to its logical conclusion, you can hear in the background the people coming to the rescue, because somebody's going to have to do something about this. It may start with changing the reserve requirements of banks. It may be swap lines for the foreign central banks. It'll start somewhere, and it will grow, but this can't continue for long. Politics is a narrative game. That's all it is. So where does the narrative lie? The narrative lies with the path of most pain until you're in a situation where you can use optimism. So the path of most pain is what they will focus on, because that's what gets votes. Human psychology is anger, resentment, fear tend to get you votes better. So what they will do is, if unemployment starts rising, which I think it will, they will start pivoting to inflation is dead, the new enemy is growth. Jobs for America. We need to help you with your bills. Even though bloody all the commodity markets down 50%, we need to do something to help you, or we need to get your mortgage rates down. You know, honest working, hard-working Americans, how can they afford their mortgages? This was the mess that came from the pandemic, but we need to get that down now. We need to get interest rates down. You can hear the narrative change. It's easy to make, right? It's all narrative. The Fed have got break-even rates of inflation down to the 2s, and if this continues for the next few weeks in the vein that it is, and if oil continues to trade towards $60, which I've been saying it's going, these break-even rates are going to come down to 1%. So the battle is won. Now, I actually think, and I've said this before, I think they've completely misread the bullwhip. And the bullwhip was post-pandemic, spikes the inflation because everyone comes in the workforce, no supply, overreact to the supply. Yes, they should have raised rates, but not like this. They've misread it. They want to be Volcker. And before they know it, they've destroyed the economy and inflation as well. And they've got their old friend back, deflation. I'm looking at the Nasdaq's down 30% already. I mean, what more do people want here? Yes, they want 50% because they want blood. Will they get 50%? I doubt it. If we go back to the Volcker era that everyone so loves, is the market was down 27%. If we go back to the 1940s, post-World War II, the market was down 22%. 1990, nice big regular recession. ISM went down to 30. Where did the stock market go? Down 20%. Everyone's convinced, talking themselves into being more and more bearish. There's a probability, and it's probably, for me, it's probably 30 or 40% that it makes significant lows, but I think it's 60% more likely that we don't make significant new lows. But let's wait and see. These are, the bond market keeps breaking and we're at 4.5% yields in 3 weeks' time. Yeah, maybe we will. The US is some 300 and something percent of GDP in debt, as total debts to GDP. It is 100% of world GDP in debt. It's the most indebted any nation has ever been. Everybody borrows dollars. And we're in a system where they're trying to act like Paul Volcker, because basically the Fed is run by a bunch of baby boomers and they want to get a book out where they're on the front cover like Paul Volcker to be the heroes. But I think what they're doing is fighting the ghosts of the past. The ghost of the past, the 1970s, was wildly different. The demographic setup is different. Also, the debt is different. I mean, the US is like 100% of GDP in debt, total debts at that point. We're now at least another 150%, maybe 200% of GDP in debt on top. So with an aging demographic and high debt, it's very difficult to generate inflation. But the Fed are now convinced they need to be Paul Volcker, and they are going to go and raise rates further than the market can deal with. And we're seeing it. We're seeing it everywhere, that the market's going, we cannot deal with rates like this and the liquidity that's happened. So liquidity has been drawn out by quantitative tightening. What they've done with the banks and what bank reserves have to be held has kept money out of the market. There's basically no buyer of the bond market. So bond market liquidity is basically as bad as it was in the peak of the pandemic, when the bond market froze and everyone was worried Citadel had gone under, whoever had gone under. That's how bad the bond market is now. It is completely decoupling from anything, and I'll come on to that in a sec. The next chart, another way of looking at it, is bond market volatility. Bond market volatility is higher than stock market volatility. This is not normal, and again, we're approaching the peak of the absolute crisis when the entire world shut down and we thought everybody was going to die. What that's done is decoupled the bond market from the underlying inflation story. So this is not a fear of inflation, really, because the Fed are saying we're going to do anything to kill inflation. Well, what's happened is the break-evens rate has agreed with that and said, yes, inflation is not the enemy. And break-even inflation, I'm looking at the 5 years, is at 2.4%, which broke down today. And 1 year is at 1.95. So they're basically around 2%. So the market's saying forward-looking inflation is back to normal. Okay, but the problem is if bond yields are going up and inflation expectations are going down, real rates have been trending lower over time. This is 5-year real rates. They trend lower because of debt and demographics. So you need to have low real rates to stimulate the economy or run it normally. So the trend rate of real rates is actually negative 1%. But we've just seen the fastest ever rise in real rates in history. So you're raising real rates on people at a time when they can't afford to service their debts because there's too much debt out there. So it's creating chaos in the bond market because the Fed have essentially gone too far with this whole mechanism between how the banks can use their balance sheets, plus quantitative tightening, plus raising the Fed funds rate. And the market's freaking out. So it's decoupled from the fundamentals as well. So the bond market, the ISM and the bond market are tied at the hip normally. Basically, bond yields go down when economic growth is falling because growth and inflation fall, and that's right. What's happened is bonds are pricing an ISM now in the 60s, high 60s, when the ISM in the next month is going to cross 50. So the ISM is going to be pointing to recession, which we all know is happening from almost every single guest we've had on, yet the bond market is broken. So it's saying the opposite. We've seen a few episodes similar, but this is the furthest it's ever been from the business cycle in bond market history. So it tells you there's a massive dislocation that's going on. That dislocation has spilled through to the currency market as well. We've already been noting, dollar yen, right? That was a specific situation because there was yield curve control, so you're printing yen. Then the UK. The UK starts cutting taxes whilst raising rates. And what happens is the currency collapsed. And today, the pound was down 3.5%. This is in the top 5 largest currencies in the world, and it's down and more volatile than the NASDAQ. This is extraordinary, but it's not just that. The Eurozone has got the same problems. South Korea, it's a mess. What we've got is a shortage of dollars, something I've talked a lot about, many guests have talked about. There is a global shortage of dollars. The Fed are taking dollars out of the system, and what's happening is the safety valve is the US dollar is skyrocketing. Now,